After Hogan Company has completed both of its PCRs for its two departments, the machining department and the assembly department, they have a record of how costs flowed through all of their various phases of production during the period, to know what went from being raw materials into WIP in the machining department, WIP in the assembly department, and finally to finished goods. And they know what portion of WIP is still left in machining and assembly, respectively, at the end of the period. Well, having them on the PCR doesn't put it on the company's books. It doesn't adjust the company's accounts to what their balances should be. So after your PCRs are done, you still need to record all of the stuff in your journals, which is what we're going to do right now. In our first entry, we're going to record the journal entry to account for direct material costs incurred by the machining department. We're going to assume this is at the end of the year because we've been doing this for December 31st, so 12/31. If we are accounting for direct material costs incurred, used in production by the machining department, that's an inventoriable cost. So that is going to go into your WIP inventory account. And because we have multiple departments, it makes it much easier to track what is where if you use sub-accounts. So I'm going to call this WIP inventory machining asset account going up. We are using direct materials, which means they have to come out of our raw materials inventory. Somebody took those parts out of those pieces out of storage to make parts within the machining department. So we have a credit to raw materials inventory. For how much? Well, it's for whatever amount of raw materials were used during the period in production within the machining department. And we have that information. So I'm just going to hit equals and where we know this debit's going to be. And I'm going to go to my PCR for the machining department. And in here we see that costs added during the period for direct materials was $40,000. So we need to record that journal entry for $40,000 to account for the fact that we already put $40,000 worth of cost into eventually finished gonculators for the cost of direct materials within the machining department. And here we used direct materials for machining. The second entry we have is going to be the journal entry to account for conversion costs incurred by that same machining department, and that $15,000 of these costs are for salaries which are owed to employees, and the remainder are being allocated from the company's manufacturing overhead pool. How's this journal entry going to work? Well, it's still on December 31st. These are still inventoriable costs. Again, conversion costs is labor and overhead, but both of those count and can be inventoried to the parts that you are building. So we're going to once again debit WIP inventory machining. And we're going to have two credits here for the two parts of our conversion costs, which we see here are for salaries owed. So if salaries are owed, that's going to be a salary payable liability account going up. And the other part is for allocation from the manufacturing overhead pool. So manufacturing overhead is going to be going down. We're taking the money out of the pool. Costs come out of the pool with the credits. Well, how much did we add for conversion costs within the machining department? I'm going to hit equals. For the debit, we're going to have the WIP inventory machining. Go back to our machining department's PCR and see that we added during the period a total of $38,000 worth of conversion costs. I'm going to click on that $38,000 and bring that over. We know from our information that $15,000 of these are for salaries owed to employees, which means the difference between those two numbers has to be how much was allocated from the company's manufacturing overhead pool. That would be $23,000. And we recorded December conversion costs for the machining department. The next journal entry we have is going to transfer costs from machining, our first phase of production, to assembly, our second phase of production. So we're going to have a debit to WIP inventory assembly and a credit to WIP inventory machining. We're taking the cost out of one WIP account and adding it to the other because this inventory that is in process is no longer going to be in the machining department. We need to reduce that account but it's being added to the WIP inventory of the assembly department. So we need to increase that asset account. How much is this going to be for? Whatever we transfer from one department to the next. We have two places we can go and look this up. If we go to the machining one, click on this credit over here, we're going to see that we transferred out a total of $90,000 worth of costs. If we wanted to, that could also be equal to the amount that we transferred in, the amount of costs added that were transferred in to the assembly department. So they're both the same number. So we transferred those $90,000 worth of inventoriable costs, and we transferred production costs from machining to assembly. Our next journal entry is going to record the direct material costs which were incurred by the assembly department during the period. Well, that entry is going to look a whole lot like this guy up here, but instead of WIP inventory machining, it's going to be WIP inventory assembly. So 1231, we have a debit to WIP inventory assembly, increasing that asset account. And those are still coming out of our storage, our raw materials inventory. How much did we add for materials in this department? Well, if we go back to our info for our assembly PCR, we see that the amount of direct materials which was added during the period is $30,000. So that entry is going to be for that same 30 grand. And we used direct materials in production one more time. Next up, we have to account for the conversion costs that are unique to the assembly department. And we're told here that $18,000 of these costs come from salaries owed to employees, and the remainder is coming out of manufacturing overhead pool. So again, that entry is going to be set up the same way as this entry up above, except now it's not WIP machining that we're adding cost to. We're adding cost to our second phase of production, our assembly department. So on 1231, we're going to have a debit to WIP inventory assembly, and we're going to have a pair of credits to salaries payable and manufacturing overhead, just like we did above. And since they're going to be the same, I'm just going to hit equals, and I'm going to go and I'm going to grab those lines from up here. So we get a credit to salaries payable and a credit to manufacturing overhead. What amount of conversion costs were added in total by the assembly department? Well, we can find that here. We see that they added a total of $40,000 worth of conversion costs for the period. What amount came from our salaries payable? Told in the information, 18,000 of that is from salaries, and therefore the remainder that's coming out of our manufacturing overhead pool has to be the other 22,000. And here we recorded December conversion costs for the assembly department. And then lastly, we finished assembling some gonculators, and those costs in those gonculators that we finished can't be in WIP anymore, because WIP, fix that typo, WIP is work in process. Those are no longer in process, so we have to transfer them off to our finished goods inventory. And we're going to credit WIP inventory assembly so that our books recognize the fact that all of those costs are no longer in gonculators, which we are still in the process of assembling. This is going to happen one last time on December 31st. So what amount of units, what amount of costs went into goods which we finished assembling during the period? Well, we can find that on our PCR. And as we see here, the amount of costs that were in goods which we completed and transferred out in total was $152,000, and that needs to come out of our WIP inventory. And now we have finished our journal entries, because this last entry is going to denote that we transferred inventory costs to finished goods.